Okay, good morning, everyone. We'll go ahead and get started this morning. And a couple things I want to point out to everyone is we've had some real difficulties with Zoom, and I know that we had about a 45-minute delay 2 class sessions ago, and about a 30-minute delay last time while they tried to come over. And I don't think their solution was any more complicated than sort of moving things around on screens. I think part of the problem here is the fact that according to our AV people, that Zoom had made some changes to the enterprise system and didn't tell us. That's the explanation. Also, we have this room is occupied by multiple faculty throughout the day, and they move things around, make some adjustments, and you never really know what you're going to get when you get here. So I apologize for that. I wanted to kind of give a brief update as to where we were in terms of the schedule. We were covering chapter 2, and I didn't quite get all the way through what I wanted to do on Tuesday, and I'm going to finish that up in a separate video later. Now, it's going to have to be later in the day because, again, as I mentioned at the outset, we have multiple classes that come into this room, and so I don't really control the destiny of this particular technology. So it'll be later, probably this afternoon. I did upload the video from Tuesday. It was about 45 minutes long or so because we got a bit of a late start. And that was covering most of the rest of chapter 2, with the exception of just a little bit more. And we'll get into that. Now, notice, and I know that I've gotten some emails from people about some confusion over due dates because I moved the due dates for this particular chapter 2 activities. In fact, chapter 2, 3, and 4, those activities were moved back a week. And just to kind of give you a little bit more time to work on those. I think it's better for you to have more time as opposed to less. Obviously, you can complete it earlier if you like. You can work ahead if you like. It's entirely up to you. The exams are not available ahead of time, but you can certainly work ahead if that is your choice. And so these are some of the due date changes. I highlighted them here. So chapter 2's quiz due the 19th, which is tomorrow. That's 11 p.m. tomorrow. And then on Sunday, 9/21, that's the final bit of chapter 2, and that's the homework for that. And chapter 3, I've kind of moved ahead then a week, as I said before, to 9/26, which is a week from Friday for the quiz, and 9/28 for the homework. And then chapter 4, and again, I mentioned this a couple times before, I pushed back to week 5. Now, week 5 is a busy week, so I urge everyone to sort of use your time wisely, because the quiz is going to be due on the 3rd, which is Friday. The exam or the homework on Sunday. That's also the due date of the exam. So kind of bide your time, budget your time. This is part of what is involved in accounting generally, is the idea of sort of sorting out your time, making it work for you, and all that. So that's the plan there. One other thing I should mention, and if anybody has any questions, feel free to let me know. Even on the Zoom call, we can hear you actually. If you want to say something or put something in the chat box, it's perfectly fine. But I do want to point out one thing real quickly here, and that is, and I mentioned this before, but I don't know that it's just kind of outside of everyone's wheelhouse, because I don't know how many people have attend anywhere, but there is an attendance link if you're watching it, what we call an asynchronous environment, that is, watching the videos sometime after the fact. And all we ask is you post your attendance. We're required to take attendance. It's an imperfect system. I understand that. I don't see any other way to do this easily. Even those who are attending in real time on Zoom, we can capture those students' attendance, but we can't really capture when you were looking at it 2 in the morning on your cell phone or whatever. So just go ahead and post your attendance. It doesn't have to be anything big at all. It's just post something, say, hey, this is when I watch the videos, whatever, right? And only a couple of people have really done that, and I want to encourage you to do that, just because it is really a requirement of what we're trying to do. So please do that if you would for us. Okay. All right. So any questions from anyone before we get going with chapter 3 and getting into really the statements, which I think is when I think of intermediate accounting, beyond the issue of talking about some of the rules and some of the historical practices and the evolution of accounting as a profession and whatnot. I think that when I think of intermediate accounting, I really think of it as sort of a walk around the financial statements and drilling down into these in a much more in-depth way than what we do in the introductory sections. And so we're going to talk about the balance sheet, we'll get to the income statement a bit later, and the statement of cash flows and all those, which we really don't cover much. If you took Principles 1 here, we don't really talk about the statement of cash flows very much, but it's a pretty important statement and an interesting statement, and we'll get into that as well. I think we also kind of come back to that in Intermediate 2 as well. And again, I'll pick up the remainder that I didn't finish up on Chapter 2 a bit later today. Those will all be posted. This should all be available tonight, and you should have that available. But again, Chapter 3's activities are not due until next week. So and I think this is just to sort of allow us to take our time to do these things right. Okay. So let's talk about the balance sheet. This is probably the most important of the statements. Out of the 4 major financial statements that are reported to external users, without question, the 2 most important are the balance sheet and income statement. There is some debate, almost a never-ending argument among accountants as to whether or not the balance sheet or the income statement is the most important. I think, without having surveyed all accountants in the world, that the balance sheet sort of comes down as being the most important, mostly because of the fact that it presents a snapshot as to where a particular company is at a point in time. And we say company here, we're not talking about governmental entities. We're not really even getting into nonprofits here in this particular course. We're talking about privately held companies and, for the most part, publicly traded companies. So public companies. And the balance sheet tends to be the most important one. Sometimes you may see it referred to as the statement of financial position. That's kind of an old school term. Balance sheet sort of is a little bit of shorthand, but it's pretty accurate in describing the fact that the assets must equal, as the left side of the balance sheet, it must equal the right side of the balance sheet, liabilities and stockholders' equity. And it sort of provides an organized list of these in terms of those major categories. These are the large categories of what we would call permanent accounts, and then everything that comes subsequent to those accounts. So an example here, and then your text talks about the example of Nike. And I've got some other examples that I'll show you, particularly as we get into some of the actual publicly reported information. But here you can see this is not a particularly unusual format for a balance sheet. You've got current assets. Again, current assets, and we're going to circle back to the more formal definition of what current assets are here in a minute. Talking about cash and equivalents, short-term investments, and whatnot. And these are all ordered in order of liquidity. So remember that when it comes particularly to the asset side, also even the liability side, in terms of what things are going to be converted to cash and within a year or the operating cycle, whichever is longer. We'll come back to that. And then property, plant, equipment, or PP&E, when it's usually presented on a net basis. And we'll talk about this idea of how we create accumulated depreciation for those assets which are essentially prepaid items. We buy a piece of equipment, or we buy 10 18-wheelers, or we buy whatever, a building, and we pay for it ahead of time, but it's also going to depreciate over time. And so we're going to allocate the cost of that asset over time. And that's essentially what that is. We'll talk much more about that, as well as the amortization of what we call intangibles. And we'll talk about that a bit. One big one here is goodwill. And goodwill is sort of a unique animal, and we'll get to that in a bit later. And then sort of the oddball, maybe oddball is the wrong word, but some unusual assets that aren't easily classifiable. And we'll talk about those other assets, which are usually at the very bottom of the balance sheet for reasons that have their own particular peculiar purposes. Okay, so that's an example of what a balance sheet looks like. On the other side, what we call the right side. And by the way, the left-right thing is simply sort of artifact of the old financial reporting. We used to get a financial statement. You used to have on the left side, you have assets, and on the right side, as you unfold it, you have the liabilities and stockholders' equity. And some of us still refer to left and right, but however you want to look at it, top and bottom, whatever, they must equal each other, and they do. So in this case, we have current liabilities. Those are liabilities to be retired within the year or the operating cycle, whichever is less. I'll get to the operating cycle a bit later to sort of refresh what that's about. So we have current liabilities, and then we have long-term debt, all these other issues of long-term debt, bonds payable, mortgages payable, things of that nature. And you have total liabilities, which is basically short-term or current and long-term liabilities. And so you have total liabilities. And then shareholders' equity, which I think we actually drill down more deeply into in Intermediate 2 than we do here, particularly as regard things like treasury stock and those kinds of transactions. But common stock, this is really the original capitalization of the company. It can change because the company can issue new shares, and so additional paid-in capital is often the value that's paid in. By the way, common stock and paid-in capital are what we call paid-in equity, and then earned equity or earned capital, whatever you want, however you want to refer to it, are those earnings which have never been distributed out, taxed away, or whatever, and they're simply accumulated on the part of the company. And then we have something called other comprehensive income or other comprehensive loss. OCI is the sort of the acronym for that. We'll come back to that. That's a little bit beyond what we want to do just yet, but we will talk about it as an element that fits into the balance sheet because it rolls over from the income statement. And we'll talk about what some of the clauses of those particular OCI activities are. But the bottom line is that the figure for the assets, in this case, we've dropped off millions. And again, remember, I don't need to remind everyone that when we say in millions, we've dropped off 6 zeros here. So it's really 23,259,000 as of May 31st, 2017. And the same figure applies on the other side of the balance sheet. Okay, so that's essentially why it's a balance sheet. And they've got to balance. And by the way, I know that in 2110, we had we have an activity where students are creating a balance sheet, income statement of retained earnings, and sometimes the balance sheets don't balance. And we always say, look, it's a big tip-off. If your balance sheet doesn't balance, you've got a problem. And by the way, I know it sounds completely insane, but there were a couple of instances when I was in a commercial lender before I left that business where balance sheets actually didn't balance, and we had the right numbers at the bottom, but the numbers within them didn't actually add up. And so bad accounting is bad accounting. So we are trying to train students on good accounting. So they've got to balance. If they don't balance, there's a problem. We're going to find out what the heck is going on. Okay. All right. So we talk about the class of the way that we can think about balance sheet is in terms of usefulness. And number one, the issue of liquidity. We talked a bit about this in Principles 1, the idea that we list things in their ability to convert something to cash, particularly on the asset side. Okay. And that is cash is obviously the most liquid because it already is cash. And things like accounts receivable are also pretty cash-like in the sense that we anticipate that we'll be collecting them fairly soon, 30 days, 60 days, whatever the credit terms are that are being offered to the customers. Excuse me. And so those are pretty liquid. And obviously things like short-term investments, and we'll get into this idea of short-term investments and how liquid they are and why we consider them really near cash instruments, things like treasury bills and whatnot, very, very liquid market for those. And as a result, they're easily convertible to cash with no problem. So that's what liquidity is really about. As we go down the balance sheet, we get less liquid. That's why we move on to long-term assets. Things like equipment and whatnot, they're not terribly liquid. I mean, you're going to find a buyer, first of all, which means you're going to find somebody who wants what you've got and you're going to agree on a price. So it's not exactly a liquid thing. Same with the building or land or any of these long-term assets that really are not all that liquid. You're going to find a buyer for them. So it doesn't mean that you can never find a buyer, but it's going to take time. So the essence of liquidity is to be able to convert something quickly to cash. And you can't generally convert equipment and property plant equipment to cash very easily. Okay. And then we get to the issue of solvency, which is a near and dear topic to my heart. And that is the idea of whether in the long term a company is able to pay its obligations, particularly the long-term obligations. And this is something that solvency is different than liquidity. And the two are different in that they seem, I think, to be similar, but they're not. Liquidity is a short-term issue, and that is when we've probably all heard people in our lives say, I've got a cash flow problem, meaning I don't get paid until, I don't know, October 15th, I've got bills coming due. It's a cash flow problem, right? Well, that would be, and I know that I'm kind of mixing metaphors with the household example, but that's a liquidity issue. That's something where there's not enough liquidity at the moment in order to pay the obligations that are due at the moment. But solvency is more of a long-term thing, and it really has to do with earnings and earnings power and the ability to service the debt primarily, and that's what's really going on. And we talk about debt service. What we're really saying is, can a borrower pay the interest on time and in full, and the principal on time and in full, and meet all the other obligations, and there are sometimes many obligations, in order to remain solvent. And if they can't remain solvent, then they've got a real problem. And sometimes, in the most extreme cases, it forces a borrowing company into bankruptcy. And bankruptcy is not always fatal. I think we shouldn't think of it as being the death knell that we're going to bury the company. Lots of companies have gone in and out of bankruptcy. General Motors went in and out of bankruptcy, and they're still around. But obviously, their creditors got zeroed out in terms of their obligations. But and that's not a good thing. I'm not suggesting that's something that companies should look at in a cavalier basis. There are problems with bankruptcy in the sense that the court basically has a lot to say about how the companies run. But nonetheless, solvency is a long-term issue. Financial flexibility is something that particularly in academic accounting, we talk a lot about financial flexibility. It's the idea that how does a company manage its resources in order to do things that it needs to do? Is it able to take advantage of opportunities? Is it able to buy a company on a very quick basis? A few years ago, when interest rates were extremely low, and they're pretty low now, but they're not as low as they were, Microsoft borrowed a tremendous amount of money in the bond market, and the CFO was asked in one of the quarterly conference calls, "Hey, what are you going to do with all this money?" And he said, "Well, we don't know. We have no plans." But the idea was that it's there if we need it, and we're paying extremely low rates of interest on it. And one of the CEOs I worked for at one time was a big fan of borrowing money in the bond market at times when the company didn't need to borrow. But he said the good time to go to the market and borrow is when you don't need to borrow. And this may be an applicable concept across other contexts as well. But that's what financial flexibility is this idea of being able to take advantage of what's available. We talk about limitations. There are some limitations, and these are pretty big. And it's something that there's a lot of debate going on right now within the accounting profession as to how we value assets. In fact, I would say the main differences between GAAP accounting and the IFRS reporting standards are probably around asset valuation. Inventory is a big one, but that's not even just the big one. It's also this idea of historical cost, and that is a lot of the long-term assets we book on the balance sheet at historical cost, even if we acquired those assets a very long time ago. And I think I told this class about the example of my own company that I worked first place I worked for out of college, where we had a property that was purchased in the 1850s, and it was still valued at a very, very extremely low dollar figure. But we had to carry on the books at that value. And eventually, our management figured out some sort of scheme in order to transfer it back. And the story that I heard, which was mostly anecdotal, was that the regulators weren't terribly pleased with the maneuver, but they kind of let it go in that regard. But historical cost, we'll talk much more about this idea of historical cost. It is a principle that's sort of embedded in GAAP accounting. And that really, when we talk about the book value of a company, which is essentially assets minus liabilities, that's the shareholder's equity. That's what we call book value. But it's not always, or even sometimes very close to market value. Book to market differences are gigantic across the economy, and it's very difficult to sort of take book value and say this is what market value is. Historical cost is one issue, but there are a lot of other things as well. And we need to really talk about why it's really difficult to simply look at shareholders' equity and say, this is what the value of the firm is worth. And there are other kinds of measures that are out there in the financial world. Something enterprise value is another one that people in the financial world use fairly frequently. But also things like, and I sort of point out in my own notes, managerial expertise, the possibility of future income streams, they're typically not reflected in book value. And some models of stock value focus on the discounted present value of future earnings, something that's not all reflected in the book value per the balance sheet. An example that I just gave that comes to mind is Oracle, which big software company just reported earnings, I think it was last week. And they were pretty unspectacular. They sort of did not meet the analysts' expectations, but the company really pumped up the idea that they're going to create hundreds of billions of dollars in sales from AI and all the things that they're doing to support artificial intelligence. And as a result, the stock zoomed upward gigantically in price. I think it was up like 30% one day or some gigantic number. Larry Ellison, the founder of the company, briefly surpassed Elon Musk as the wealthiest person on the planet, but Musk, I think, has retaken the lead in that interim. But nonetheless, you get the idea that sometimes it's what the future holds, and that's not reflected on the balance sheet. There's no indication there, and there's no indication of what management expertise or product development or new products coming out. None of that's really reflected there, and so there are some limitations that just simply look at the balance sheet, and those are valid. Criticisms of what the balance sheet is, but the balance sheet doesn't purport to do anything other than what it does, and so we have to be clear that some things are not recorded, and therefore they have really no book value whatsoever, such as new product development. Who would have thought when Apple was almost bankrupt, and had to reach out to Microsoft of all people? It's like Darth Vader reaching out to Han Solo or whatever for money, that Apple would come up with the iPad, iPhone, all these other products, and sort of become at one point the most valuable company in the world. You couldn't understand that just simply by looking at book value on a balance sheet. So the differences in book and market are pretty big. And this doesn't even get into the issue of historical. I mean, it includes historical costs, but that's not even really the main issue, in my view. The historical valuation of assets. It's a lot of other things as well. Okay. So these are some shortcomings that should be understood when we look at balance sheets. And this is something that I think needs to be really communicated to everyone who looks at financial statements, is that you really have to understand the big picture. Don't just look at one thing, look at a lot of things, and look at a lot of different elements of what's going on. And if you really are, let's say an investor, you're looking to buy into a company, do your own homework, and you're going to be better off doing your own homework if you're more informed as opposed to less informed. Unfortunately, a lot of people are not as well informed as they ought to be, and so as a result, looking at financial statements themselves is sometimes misleading, just simply because of the fact that the way we report things doesn't always include the most important elements. Okay. All right. Questions? Anybody here or abroad? So here are the categorizations: current and long-term assets on the asset side, current long-term liabilities. We kind of got into that. We have paid-in capital and we have earned capital. Paid-in capital, retained earnings, and so those are essential classifications. These are broad categories, and within these we have permanent accounts that never get closed; they just get updated. And we'll talk about closing as to what that whole process is about. I think most of that is in chapter 2. Actually, I don't think I got to that last time. Quick question: which of the following is a subclass of assets on the balance sheet? Cash and equivalents, revenue, current assets, disposable assets. Well, the only one is here is going to be current assets. It's a category. It's a category, and it's got its own separate subtotal on the statement itself. Current assets, long-term assets, those are subtotals, and so those are categories. And they don't represent any accounts; they represent a collection of accounts that are grouped together based upon the characteristics. In this case, the characteristics are in terms of liquidity and the idea that these current assets are going to be converted to cash within a year or the operating cycle, whichever is longer. So this leads us to the next logical topic, the operating cycle. What the heck is the operating cycle? So the operating cycle for a company is basically the easiest way to think about it is the cash to cash cycle. And that is, we have cash on hand, we buy inventory. Now, maybe we buy it on credit, maybe we buy it on cash, probably on credit for 30 days or whatever. But nonetheless, we use cash on a very short-term basis to acquire inventory. We get the inventory ready for sale. We sell it to our customers. And we collect cash from the customers. And so cash goes back to cash, and again and again and again. Now, there are some companies where this cycle is very, very quick. We've got this, what we call inventory turnover, and receivables turnover for that matter, because they all involve cash. But the big question is how quickly we can convert these to cash. I would argue the accounts receivable turnover is probably a little bit more germane, although when we're talking about retailers, Walmart, Target, Home Depot, they don't really sell on credit to customers. Maybe contractors with Home Depot may have a credit account, but if you go to Walmart and buy a hairdryer, you're not going to say, I'll pay you next week or whatever. I mean, you've got to pay on in cash. And so that cycle is very, very quick. And by the way, when we talk about Walmart, I don't know about you, I go to Walmart every now and then because it's close to my house. If I get there late at night, because I don't usually leave here until later in the day, but sometimes there's real stockouts of inventory items. That's just how quickly they move stuff. Just things just go flying off the shelves. And so they have a very, very quick operating turnover. Obviously, some things are going to move slower than others. Things like gas grills and snow blowers are probably going to, or leaf blowers or whatever, are going to move slower. But for the most part, a lot of the stuff like shampoo and Band-Aids, they're going to fly off the shelves. And so this stuff is different. If you've got a company that has more long-term assets for sale, things like durable goods, things like appliances and furniture, that's not quite as fast moving. And so you're probably going to have a little longer operating cycle. But a year may be too long for that. And I know your text got into the idea of saying there are some organizations that have very long operating cycles. And we're talking about construction companies, primarily they're doing long-term construction projects. You're building a casino, that's probably going to take a little bit longer than a year. You're building an aircraft carrier or whatever. These are things that aren't quick. And so the operating cycle is a little longer. And so as a result, 1 year is not sufficient in that regard. But for the most part, I think when in doubt, I think we usually default to a year as the operating cycle. And why do we need to know what the operating cycle is? Because we need to know how to classify current assets and current liabilities. And how do we put them there? And by the way, we do ratio analysis that we compare current assets to current liabilities. Sometimes we include inventory, sometimes we don't include inventory in these measures. And we want to know how liquid the company is. Remember, liquidity is a short-term issue. And so if we're talking about the ability to meet short-term obligations, we kind of need to know what's coming up and what's coming due. And this is a lot of what corporate financial control is about. Excuse me, is knowing what's coming up and what to do about it and how we're going to meet these needs. Because keep in mind, obviously creditors have probably priority over shareholders. I shouldn't say probably, that's really the case. But we've also got, and I think it's overlooked, in my opinion, it's an unfortunate overlooking, and that's the idea of employee salaries and benefits and wages and whatnot. And most companies have no trouble, public companies have no trouble meeting those, but when push comes to shove, sometimes that's not always the case, particularly for smaller businesses. But the idea of prioritizing obligations in order to meet those obligations is an element of financial control. Okay? All right. When we talk about this issue, I've already kind of discussed the idea of liquidity, and so it goes down the list here. Cash is obviously the most liquid, and we kind of go down the list here. Short-term investments, receivables. Receivables are trade receivables primarily. That is, I sell something to you. This is primarily business-to-business transactions or business to government or whomever, but I sell something to you, you pay me in whatever the terms are, 15 days, 30 days, whatever the case might be. The inventory is a little bit less liquid, and some inventory is not particularly liquid at all. And then we get to prepaid expenses, which are what we covered a little bit, well, not a little bit, we covered quite a bit in chapter 2 in terms of what we call deferrals, and that is we're prepaying things ahead of time. And what are we deferring? We're not deferring the payment because the payment's been made. We're deferring the activity. Remember, don't follow the money, follow the activity. And so a prepaid expense is usually a current asset. There are long-term prepaids, and I think we get into that a little bit here. And yeah, there are long-term prepaids, but for the most part, prepaid expenses, I think, tend to follow the pattern of insurance, rents, leases, those kinds of things. That's really what we're talking about. And as they're used up, we simply move them out of prepaid expenses. We credit prepaid expenses and we debit the expense itself or whatever it is. Okay. All right. So in this example, we have a current asset section of Nike. And we've kind of seen that before. We have cash and equivalents and whatnot. And we have a comparison of one to the other, which is kind of good. By the way, I wanted to pull up here and I want to show you just an example of what publicly traded companies reports look like. And I'm going to pull this out of hopefully I can get it up here on the screen, pull it out of what we call the EDGAR system. And EDGAR stands for nothing other than, nothing more complicated than the electronic data gathering and retrieval, I believe, is the acronym. It's maintained by the Securities and Exchange Commission. And I pulled up Apple. This is a company well known. So talked about Apple a second ago. And this is as of the fiscal year ended September 28th of 2024. Now remember, companies have fiscal year ends that often don't match December 31st, the calendar year, and they do it for their own reasons. And it's something that obviously makes sense, but this is what it looks like, and it goes on and on and on and on and on. I would say the majority of people do not look at this, but I will go here to click on the hyperlink. That's one of the nice things about about the internet is we can click on this. So we have an income statement here. We have sales, cost of sales. Also, we have a consolidated statement of comprehensive income. Now, remember, we talked a bit about this in chapter 2. The comprehensive income we call OCI, other comprehensive income. They usually relate to things like currency issues where we're converting the value of not one, multiple currencies back to US dollars if we're reporting in the US. Also things like pension valuation changes and whatnot. In this one, they've got actually a pretty good loss, about $832 million loss in changes in the value of derivative instruments. I don't know what those are. We can look in the notes and find out what they are exactly. Sometimes companies will try to do hedges, try to have offsetting positions for to try to protect them from downside in some underlying issue, but we don't know exactly what that is. But here's the balance sheet for Apple. So you've got current assets, which is cash and equivalents. Always top line. Marketable securities, accounts receivable. Net, we say net, and we're saying we're allowance for doubtful accounts because most companies do not plan to receive every dollar amount of receivables for all kinds of reasons. And it's not just that their customers are deadbeats or walking out. They could be the companies that have purchased from them or themselves having difficulties. Maybe they're in bankruptcy themselves. Who knows? Maybe they're in bankruptcy because of lawsuits or whatever. We don't really know. So we have current assets. Again, we have marketable securities. Now we got marketable securities here and we got it there. I'm gonna put this on the back burner for a minute. I do want to come back to that to talk about why these are different. Okay. In this case, we've got two different dollar figures, but they serve different purposes. So I'll come back to that. PP&E on a net basis, that is net of depreciation, and we have total assets. And so here, and by the way, we have 2 years back to back. Current year, which is the most current fiscal year, September 28th of 2024. Prior year, September 20th of 2023. And you can sort of follow the changes. This is a lot of what we call horizontal analysis, where we can sort of go year to year and look at these line items. But the bottom line is this figure here is going to equal that figure there. And so that's what is the issue going on with the balance sheet. And so this is just one of many examples that we can use. And I kind of like to refer students to the Edgar system. Easy to get to. It's free information. You can get to any publicly traded company in the U.S., even if they're not based in the U.S., but they trade on our public markets. You can pull up their information and very easily find out what's going on. And one big thing, and I'm a little bit ahead of myself, but I will talk about the fact that there are lots and lots and lots and lots of notes explaining what the heck is going on and why we did what we did. By the way, here's this issue of derivative instruments and hedging. I haven't looked ahead of this, but I sort of suspected that what it was some sort of hedging losses and whatnot. And but you get the idea. There's a lot of it. Now, do most people read this? I don't think so, but professional financial analysts do, and it's what they do for a living. And they study this pretty intensely and and give advice. A lot of them work for financial firms and give advice so that their clients can make good decisions based upon their own independent analysis of what's going on. Okay. And everywhere in accounting, there's a term called professional skepticism. And it sounds like I just kind of made that up. I just pulled it out of my hat. But it is this idea that accountants are, by training and by temperament and really by regulation, required to be skeptical of what's being given to us by our own clients. And we need to verify. It's kind of like what Ronald Reagan said, trust but verify, So we have to make sure that we can understand that. And the reason for that is the fact that, unfortunately, not everyone is a truth teller. And that's, I don't think anybody needs any convincing on that. But being professionally skeptical is part of the goal here, is part of the practice. Okay. All right. Any questions for anybody on the Zoom call or here in the class? We only got a couple people here, so I think most people are watching this on a non-live basis. And feel free to reach out to me, by the way. I know a lot of people have emailed me And I'm trying to get back as quickly as I can. Sometimes the questions are rather lengthy, and it takes a lot of time for me to figure out what the question actually is. But I do my best to do that. So, all right. So let's do this walk around the balance sheet. Let's talk about cash and equivalents. All right. Top line on the asset side of the balance sheet. So when we're talking about cash, we're talking about physical cash, but not so much physical cash, more cash in banks, but also these other instruments that are really essentially cash. I don't know much in the way of cashier's checks and money orders are held by companies and converted and captured in cash, but I suppose it could be. One of the issues that I think we should talk about is equivalence, and we're talking about things like commercial paper, money market funds, and treasury bills. Commercial paper, these are short-term obligations, and it's usually one corporation lending money to another corporation. And how it really works, and I got pretty familiar with this from my time in banking because we were rapidly losing some clients to investment banks because a company would say, I need $25 million, I need it in a couple days, or 5 days, or 10 days, or whatever. And they would call their investment bank and say, I need whatever it is, $25 million. And so they would arrange this transaction where one company will lend to another company, usually on an unsecured basis. It would definitely be interest bearing. It would be an instrument that was interest bearing, but a very, very short term nature. And you can kind of cut out the banks. Banks have this way of being very nosy about what you're doing. And so a lot of companies don't like to borrow on a short term basis. I will say, though, that almost every company that I dealt with, even the very largest ones, would have payroll lines of credit just because of this absolute essential fact of having to pay workers on time and in full. And so lines of credit would be there for that, if for no other reason, as well as in some cases to facilitate international trade. But commercial paper, though, is a very big market, and it's very liquid. I mean, it's convertible to cash in a very short period of time. I think it's probably negotiable as well. I am not an expert on the paper market, but I do know it is a very short-term thing, unsecured, interest-bearing, but it's going to be converted to cash quickly if you're the one doing the lending. Money market funds, these tend to be not FDIC insured, but they're composed of very, very short-term instruments, things which you probably don't want to get into here, things like bankers' acceptances and all that, things which are very, very liquid and very, very safe typically. And money market funds have even been extended to the consumer level as well for a long time. And so they're out there. They tend not to be FDIC insured, however, and then the U.S. Treasury bills. What's interesting about Treasury bills, so when we talk about government borrowing, our government borrowing is a lot. It's the biggest debt in the world by far, in the history of the world by far. And when we talk about bills, we're talking about maturities that are under a year or under, I think is the definition. Anything over a year, 2 to 10, I think are called notes, I believe, and then anything over that are called treasury bonds. But they're all short-term obligations. I'm sorry, bills are short-term obligations to the government. They are sold at a discount, and you buy them 3 months, 6 months, whatever the case might be, and they're extremely liquid. If you buy them on Tuesday, you can sell them on Wednesday. If you buy them on Tuesday, you can probably sell them on Tuesday. I mean, it's not that difficult. They are interest-bearing, and they're very short-term obligations to the government. I saw an article last week that indicated that Berkshire Hathaway, run by Warren Buffett, the great investor, has somewhere around 5% of the total U.S. Treasury bill market. They have about $300 billion in U.S. Treasury bills at the moment. You might think 5%, that's not very much, but we're talking about a gigantic market, one company owning a big piece of that. We've heard Buffett talk a lot about his concern over stock values at the moment, and this is not an investment course. I do not want anybody to take investment advice from me, but I think it's an interesting idea, the idea of parking money on a very short-term basis, usually right now about 4%. So I think the rates have been falling a little bit lately, but a pretty good yield for a very, very extremely safe investment. And by the way, we call treasury bills, bonds, notes, treasury bills, notes, and bonds, the return on those to be risk-free because the government is not considered to be a debtor that will walk out on its debts. Okay. All right. Short-term investments. These are investments in other companies, primarily the stock and debt of other companies themselves that have issued not one's own company, but other companies. And companies have extra cash and want to do something with it. Sometimes if they don't want to put it in things like commercial paper and treasury bills, they want to do other things with it, such as holding securities. And so if the company has the ability and the intent is a big thing here, to sell within the next 12 months, and we call it a current asset. Short-term investments are a current asset, fall in the current asset category. But if the intent is longer, then it's a different situation altogether. It moves down the balance sheet. It's considered to be less liquid in that regard. The short-term investments are those which we call held to maturity trading and securities available for sale. These are things that I think we get into this a bit more in intermediate 2, but it's really the way it's based upon the intent of what the company is doing as it purchases these. And by the way, one of the causes, I think, of some of the bank failures of, I guess it was, I don't know if it was 2 or 3 years ago with Silicon Valley Bank and some others, was the way they were classifying these short-term investments, and interest rates were rising, and which meant the value of these things were falling because they weren't as attractive as the newer issued securities. And so they were posting some losses on that simply because they had to, because they were short-term investments. And it's what led to essentially the failure of that bank. And so if you're really interested in that issue, there's a lot of information out there as to how that all came about. But that's it really is based upon what the intent of the holding of those were about. Okay. Receivables, trade receivables, essentially, these are transactions. We sell something to somebody, we sell a good or service. They owe us in some period of time. Nothing terribly complicated about these. A lot of big companies have entire departments that are called accounts receivable, where the staff there does nothing but collect receivables and post the receipts of those receivables and prepare schedules for those that are past due and whatnot, so people can take action on those, and particularly in an accounting context, to be able to be able to estimate what are the future bad debt expenses that are coming down the line. And that's, again, we come back to this idea of the balance sheet being a little bit not quite what you might think it is, because some of these things are based on estimates, and one of those estimates are the collectability of receivables, and so that's an issue. Notes receivable are a little bit different than accounts receivable. We're talking about notes receivable, we're usually talking about something which, so the bigger dollar figure usually relates to one particular transaction in general, and there's almost always some sort of formal document. Accounts receivable really are nothing documented more than something like an invoice, a bill of lading, whatever, in the normal course of doing business. And so companies generate receivables all the time. Just a big number of those. Notes receivable are a little bit less common. Excuse me, it's a little cold here. I'm sorry to cough a little bit. So notes receivable, they tend to be interest bearing. It usually tends to be written and with all kinds of terms. Is there collateral involved? What are the repayment terms? What is the interest rate? What happens if there's a default? All these other provisions, which are sort of built into a note receivable. And notes receivable, in this case, are for the company, we are extending credit to someone else for something, whatever it is. And this is not all that unusual, where a company will sell an asset, an inventory asset, to another company, and it's an expensive item, and so the company can't pay for it immediately. So you can't create an account receivable, but instead it's like, okay, we'll sell you this good, and we'll create a receivable as a result, and you'll pay us back over 24 months or whatever the term is. I had a little bit of involvement with the elevator business, believe it or not, where elevators are extremely expensive items, and elevator companies were selling elevators to builders and on credit terms, and they would create a receivable because companies didn't want to pay for the entire amount up front. So that's one example. I think there's probably numerous examples. The trucking industry, which I had some involvement with, often involves this idea of notes receivable. And they tend to be more of a longer term nature. We are talking about current assets here, and so I'm sort of mixing current and long-term assets here. But notes receivable tend to be more associated, I think, with longer-term liabilities. But you can definitely have short-term notes, no doubt about it. But they tend to be, in all cases, interest-bearing. They don't have to be. There's no requirement. It's two parties agreeing to something. But for the most part, they tend to be interest-bearing. And then we get to inventory. Now, if you took 2120 here, I know we talked about these We definitely have a manufacturing orientation in our Principles 2 course, which is managerial accounting. And we focus on manufacturing and these really three main categories of inventory items: raw materials, work in process, what we call WIP, and finished goods. And so they're listed separately on the balance sheet, and they're definitely inventory items. Raw materials are simply those goods, and they don't have to be, and I know I say this all the time in my 21-20 courses, they don't have to be like something that's extremely raw, like just got dug out of the ground or chopped, a tree being chopped down or whatnot. They could be finished goods, but they're extremely raw. Things like screws and bolts and lumber and paint and all that. Those are things that are not, raw materials in the sense of just, like iron ore or whatever, right? But they're raw materials to the company itself. And so until they're applied to the particular inventory production, they are going to be raw materials. But as they're applied, they sort of work through the process, and we absorb these costs into the cost of inventory itself, first to WIP, work in process, then to finished goods. And then, and only until they're sold, do we recognize an expense. And that's one of the unique things about inventory, is that we capitalize those costs. And by capitalize, I mean we put those on the balance sheet as an asset until those goods are sold. And so they're carried on, and it could be a while before they're sold, but nonetheless, they are carried as inventory items. Okay. And then finally, to sort of round out our discussion of current assets, we get to prepaid expenses, and that arises when a company incurs a cost of an asset in one period that won't be expensed until sometime down the road. And insurance is the classic example here. It's not the only one, certainly, but and whether it's current or non-current depends upon the period in which it's consumed. Now, remember, I mentioned a second ago that there are long-term prepaid items, and it really depends upon what it is that we're talking about. If we're paying something well ahead of time and it's going to be over that operating cycle, we would probably book it as a long-term asset, a long-term prepaid. But in general, when we talk about some of the big issues here, prepaid rent, prepaid insurance, those are the biggies. Supplies, I suppose, I've got my own pet peeve on supplies, particularly in the service company context. But the idea is that we're paying ahead of time. These are going to be used up quickly. And by quickly, I mean within the operating cycle. And so, but we're carrying this particular asset over time because we haven't used it up yet. Remember, we don't expense things until we've incurred those expenses. So if we prepaid insurance and we haven't used it yet, then we can't expense it. It's going to be asset, not expense. And so, and as it's used up, every time we do adjusting entries, we're going to adjust that particular figure. And when are we going to do adjusting entries? As we lead up to some end of an accounting period. In the case of public companies, it's on a quarterly basis. Other companies, it's whenever they really choose to do it, but you kind of get the idea. And by the way, there's a proposal right now to have quarterly reporting go away and be replaced by semi-annual reporting. And we will see what happens with that. It's an interesting idea. I don't know what's going to happen with that, but quarterly reporting is sort of the norm. And for those of us who've been in the finance world for a while, we usually look to public companies to report on a quarterly basis, and we sort of expect it. So when we get to semi-annual, there will be a change. We'll see. We'll see if it happens. If it does happen, what about it? Okay. Okay. So questions about that topic of current assets. Real quick question here. Current assets include cash and all other assets expected to be what? Well, it's not 1 year. It's not operating cycle. It's 1 year within the operating cycle, whichever is longer. So it's going to be D here, okay? Whichever is longer. All right, so I want to get into long-term assets. And again, I think I may have mentioned this in the outset. A lot of what we're doing in Chapter 3 should be familiar if you took Principles 1 relatively recently, because we drill a little bit deeper into these topics, but this is for the most part hopefully overview of some things we've essentially covered before. So what about long-term assets? We're talking about assets that will be converted to cash or used up longer than the operating cycle. In other words, more than a year, or the operating cycle, whichever is longer. And so what are we talking about here? Well, we have investments. Now, investments, we talked about it before, and we're assuming in this case these are liquid investments, bonds and whatnot, but we don't really know. It's a kind of a vague category until we kind of find out what's inside that category. PP&E, property, plant, equipment. Intangibles, we'll get to in a second. Other long-term assets we'll also get to in a second. But they're sort of listed in this direction. Now, by the way, One big one here is goodwill. And goodwill, if you remember what goodwill is not something you generate internally. It's something that you acquire as really it's the way that we do the accounting treatment for a premium paid over book value of a company that's acquired. Typically, that's really what goodwill is. And remember, book value's got its own limitations. Market value often is much higher than book value. How do we reconcile these numbers? How do we do it? We do it by debiting an account called goodwill, and we tend not to. At one point in the distant past, because I've been sort of around a while, we used to amortize this. That was write it off over time, and I believe it was 15 years was sort of a convention, but we don't really do that so much anymore. But we will adjust it for what we would call an impairment of goodwill, and that's a little bit different. And impairment are the tests for impairments are things that are required of accountants for public companies. And there are things that if you take more advanced accounting courses, you'll get more into this idea of what these impairment tests are. Are these assets really worth what we say they're worth? Even the book value, which may not reflect the market value, cannot fall below book value. Otherwise, we have to make an adjustment for impairment. And impairments are considered losses in the short term because of the fact that we have ascertained and concluded that these assets are not worth whatever they are. And the tests for those are a little bit beyond what we're doing here, but you want to be aware that those do exist as things. So when we talk about investments, we're talking about things that are not directly involved in the operating activities of the business. These are securities in other corporations. There's also land held, things like longer-term receivables, cash on the side for special purposes. And I'm going to kind of circle back to this idea of cash for special purposes a bit later. I do want to get into that a little bit here. Oops, what did I do here? Actually, okay, yeah, I'll come back to that here in just a second. So I lost my thread here. So property, plant, equipment. What are these? These are typically physical assets used in production and are necessary to the business. They're operating assets, and they have a long-term nature. So we're talking about equipment, furniture, fixtures, computers, vehicles, you name it. I mean, the list goes on and on of what property, plant, and equipment is all about. And we report it on the books at the cost, but we adjust it over time for accumulated depreciation. And so accumulated depreciation is simply what we call a contra account that accumulate all the prior depreciation in prior periods, including the current period, and that reduces the book value of the particular asset in order to account for what? The idea and it's not just the idea that goods wear out over time. That's true. I don't think anyone denies that, but it's also a cost allocation mechanism. Because when you buy a piece of equipment or you buy a building, what you're really doing is it's a prepaid item and you're going to be using it up over time. Now, the estimated time period is quite fluid and subject to some judgment and whatnot. In the tax world, it's not with the world I work in. It's not quite so subject to individual judgments, more based upon what the guidelines are. But nonetheless, the estimated useful life is sort of set ahead of time, and we're going to write that asset down over time, and because we're spreading out the cost of that over a longer time period. And in fact, it does qualify as an asset, that is, this resource owned or controlled by a business having future service value, so that it meets that particular definition. Examples are all around us. Land. Now, we don't depreciate land. Land doesn't depreciate. However, land can be impaired. And so sometimes land, we saw this a little bit in the early 90s where we had some clients owning gas stations and they were leaking fuel out of their tanks into the surrounding land and really destroy the land. And so the land was impaired. So we don't depreciate it. Impairments are sort of one-time things, but it can be written down over time, but just not depreciated on a fairly smooth schedule like what we have with depreciation in general, particularly straight line depreciation, which is a very smooth linear schedule. Buildings, equipment, machinery, furniture, all these kind of things, but also things like natural resources, mines, timber tracts, and some of this is a bit beyond where we're going to go here. Particularly these extractive industries, it's a little bit more complicated, and the rules are a little bit more challenging in that regard. But I will add that other things that could be depreciated are things like livestock. You can actually run up the value of livestock if you have racehorses. Racehorses can be depreciated. So yeah, living things can also be subject to depreciation as assets as well. That's one of the things that sometimes bugs people, but it nonetheless is are part of the rules. Okay. All right. So, any questions about PP&E and what those are about? We'll talk much more about, particularly the creation of these long-term assets as we get going a little bit deeper into the class. But they are assets that will be expected to exceed a year or the operating cycle, and they're going to be around a while. They're intended to be around for a while. Okay. Okay, so now we move into intangibles. What are we talking about here? Intangible assets are these things which really tend not to have a physical presence at all, physical substance. You can't put them on a truck or move them, which is kind of good, and you can't burn them up in a fire. They can't really be shoplifted, and that's good. And so all these assets which do not have the particular risks of physical assets are good. And we put them on the books. They tend to be in the form of these particular categories: patents, which are basically short-term rights to a particular product, process, and whatnot. Formula, the drug industry we think of patents as being huge in the drug industry, where they've got an X number of years, where the only company that can sell whatever the good is, right? Copyrights, which are more intellectual property, things like written works, music and whatnot, and those have a little bit of longer life. Trademarks, which are based upon things like slogans and logos and images, and they have a fairly long life in their own right. And then also goodwill, which we talked a bit about before. Goodwill is simply this accounting measure by which we account for the difference between the price paid for assets and the book value of said assets. And we also report them when we say net of accumulated amortization. Amortization is a topic we covered in 2110. And what is it? It's simply the writing down of the value of something over time because it has a limited lifespan. And in fact, depreciation is really a form of amortization. Amortization, sort of comes from the Latin where the mort part is death. We're bringing something down to zero. We're killing off the value of something over time. And amortization really applies, in particular, to intangible assets, where if we know we have 8 years left on a patent, we're going to write that down over a period of the next 8 years, right? And at the end of 8 years, that particular patent value, which is the intangible asset, is going to be reduced essentially to zero, right? And by the way, in the drug industry, one thing we have seen happening for a very long time is companies will have a patent on a drug, and we saw this, especially with some of these breakthrough drugs like antidepressants and whatnot, where they were introduced, and companies had their own, all big companies had their own antidepressants, and then suddenly, when the patents expired, there were all these generics that were out there, and so those weren't quite the blockbuster drugs once the patent expired. So, and I think we'll probably see that happen with things like the GLP-1 drugs that are out there, where people are using it for weight loss, which I don't believe was the original intent, but nonetheless, you get the idea that these have a limited lifespan, and so companies will use those to the best of their advantage. And if they differ a little bit from their competitors, well, that means that they have a different patent, it's a different drug. And certainly we saw this in antidepressants, where we had different formulas that did different things, and nonetheless they had very high prices, and that's really what patents allow a company to do, is to charge what is essentially what economists would refer to as a monopoly price, at least for the period of time that patent is in existence. And then once the patent goes away, there are all kinds of generics and other competitors, and it's really difficult to sort of keep secrets as to what's in a drug, that sort of thing. Okay. All right, other long-term assets. All right, let's talk about other long-term assets. This is I kind of like the term that is used here, the catch-all, and that's anything that's not previously classified would be but as a long-term asset would go into long-term assets, and it can include things like long-term investments that really are sort of difficult to quantify, and where you're potentially buying into a company that has essentially no earnings and no product even. And there are companies that are out there that exist for years and years and don't even have a product, and you have investors in the company itself. And so how do you as an accountant, how do you measure the value of those? It's really, really difficult, right? And also when we talk about is it an asset or is it an expense, relates really to the management intent. So that's essentially what's going on. By the way, what some of the other things which go into other long-term assets, sometimes companies will set aside funds to settle litigation. That's been going on for a very long time. And it's not always clear how much the liability is going to be, but they'll be reserving assets in order to pay litigation costs and expenses to some plaintiff. And by the way, one of the things that I should point out is if you pull up the EGGR website for almost any public company, you'll see in the notes, if you want to immerse yourself in the notes, you'll see that most companies are involved in some kind of litigation pretty much at all times. And it's just a reality of our world today. And whether they're a plaintiff or a defendant, in this case, if you're a defendant, you think you're going to lose. And there are different elements by which accountants work with attorneys to decide how much we create as a reserve. But that'd be one issue where you might set aside funds as long-term assets. They're not liquid, they're long-term, definitely, and they may take a while, and they're not going to be considered part of current assets. Also, things like companies will sometimes set aside funds as sinking debt in order to retire long-term debt. So a company borrows a tremendous amount of money for a very long time period, but also sets aside some earnings in order to pay off the principal at some point, if they want to do that. So that's one issue there. But litigation is one that tends to sort of come to mind when we think about other assets which are of a long-term nature. Okay. A quick concept check: which of the following is most likely to be reported as a long-term asset? Well, receivables would not be, prepaid rent would not be, inventory would not be. It's got to be buildings, right? Because the other three, receivables, rent, prepaid rent, and inventory, those are all current assets. And so again, the ability to differentiate long-term current is an important topic, an important issue. And sometimes it's not always clear, but it's usually clear. It's not, I don't mean to present it as being all that ambiguous. And then another concept check: which of the following represents tangible, long-lived assets using the operation of the business? Current assets, investments, property, plant, and equipment, intangible assets. Okay, well, long-lived is the key term here, and that's going to be property, plant, and equipment. Certainly not intangible assets, because intangibles are really not, I guess this is maybe a gray area. Are intangibles part of the operating assets of the business? I really don't know, but the best answer, and this kind of goes back to the best answer concept, is going to be property, plant, and equipment, because there's no question about the fact that we invest in these long-term assets in order to help the business do whatever it is the business is doing. Okay, any questions so far about anything? And by the way, you can put something in the chat box if you like. I try to circle back to that occasionally when I'm able to. So, okay, let's go on a little bit more. We got about 11 minutes left, so let's kind of go on here and talk about liabilities. Okay, so now we're gonna cross over the other side of the balance sheet and talk about liabilities. Again, we're talking about this chapter segment deals with the balance sheet. So we talked a bit about assets, and we'll talk more about assets, but we want to talk about liabilities now. And we have all these issues that are called current liabilities. And when we talk about current liabilities, we have different categories. Accounts payable, and we'll get to that in a second. These are trade payables that we, the company, owe somebody else to supply whatever it is we're acquiring from them. Inventory, materials, supplies, whatever the case might be. These are very short-term nature. Just like accounts receivable, they're in a very short-term nature. And by the way, a lot of times one of the challenges for businesses, particularly smaller, less capitalized businesses, is this mismatch between the due date for accounts payable and the due date for accounts receivable. And that is, if receivables are coming in slower than payables are due, that's kind of a liquidity issue. And so it's one of the things that we should look at. I know that when I was in banking, a lot of times we recommend to companies that they simply inject a big amount, even of borrowed money, long-term, in order to boost their current assets, just to kind of get them over the hump, particularly if they couldn't do anything about these due dates. And the stronger you get, the more leverage you have over, these due dates. and timing issues, but that is one issue that comes up. So current portion long-term debt. I'm going to come back to this in a minute, and we'll come back to notes payable. These short-term obligations. I kind of talked a bit about notes in general, and kind of maybe verge a little bit in the long-term aspect of it a second ago. We'll come back to that in a minute. But we have current liabilities, which are those liabilities that will be retired within a year of the operating cycle, whichever is less, or I'm sorry, whichever is greater, and then long-term debt. And the long-term debt are primarily, if we're talking about publicly traded companies, we're talking about bond debt, mortgage debt. A lot of this is in the form of the bond market, and a lot of companies will raise funds in that particular market. It's a way to raise lots and lots of money very quickly. It's interest bearing, and it's usually, once it's acquired, it's certainly a little bit less onerous than borrowing from banks, for instance. So banks tend to have a way of nagging their customers, their borrowers, a little bit less the case once debt is issued in a long-term nature here, so in a bond market capacity. And then deferred income taxes. And by the way, when it comes to taxes, I'm a tax person, so I like this topic, but I know it sort of takes us away from the main event here. So things like deferred taxes are things that we don't owe yet, but they're coming due, and maybe we're making provision for those and whatnot. And by the way, you can also create, on the asset side, things like what we call deferred tax assets. And those things, we've got benefits coming to us from taxes because we couldn't write certain things off and whatnot. So, but again, I want you to, all I want you to know about that right now, because this is not a tax course, is the idea that these tax issues are there and they do impact the GAAP's reporting, but they're not really part of the main thrust of what we're doing here. Current liabilities. Okay, what are these? They're typically satisfied the use of current assets or the creation of other current liabilities. Okay. Now, I don't know, and I know maybe it's considered bad form for college profs to sort of disagree with textbooks, but I don't know that I typically really agree with that so much, because there are a lot of companies that have a very thin relationship between current assets and current liabilities. Back in the day, and I'm talking about a very long time ago, it used to be this notion that was sort of almost accepted as like gospel truth that current assets should exceed current liabilities by about a 2-to-1 ratio. Today, that is really not a thing that we sort of hang our hat on. I mean, but it's a real, and I bring it up because occasionally I'm sort of banging around the internet. I sometimes see it. But that is not really the case, because, and it's not always the case for current liabilities, because some of the companies that have current liabilities are just cash generating machines. And so they can just generate cash just through their normal operations, and they can do a lot of other things. But current liabilities, what we're talking about are things like accounts payable, short-term notes payable, deferred revenues. Remember, those are liabilities. These are prepaid items or deferrals. People pay us ahead of time, but we owe them. And remember, liabilities in general, this sort of wonky definition is it's a claim on assets. So in other words, it's the claim on the company. So it's a deferred revenue. It's a deferred revenue. It's a liability. And any kind of accrued liabilities, things like accrued wages, accrued interest, or big ones. Back to my point here a second ago, I just want to point out, there's a reason why I pulled up Apple, and that is, let's just take a look at their balance sheet and just kind of show you what's going on here, if I can find it here. Let me see here. Okay, so if you take that's the balance. That's the income statement. All right. Okay, here we go. So current assets, 152 billion in current assets. They're cutting the millions off, so we chop 6 zeros off. So 152 billion in current assets, 176 billion in current liabilities. So they have more current liabilities than current assets. Now, you may be, if you're really a stringent adherent to the idea of you have to have more current assets and current liabilities, then you might think, oh my gosh, Apple's in trouble. Well, I don't know that anybody is saying Apple's in trouble. It's one of the most valuable companies in the world, a gigantic moat. I mean, you're talking about, $30 billion in cash, just on the books right there. And so are we really talking about a difficult situation? I really don't think so. So it's not, this relationship, this is not quite what it seems. And by the way, the other thing too that we should mention is that companies have access to a lot of sources of funding that maybe back in the day they didn't have. And commercial paper is certainly one of those where they can issue it very quickly and receive cash very quickly. And so raising money from all kinds of different sources, domestic and foreign and whatnot, are not that challenging. So, but nonetheless, I just kind of wanted to point that out a little bit because I think that the idea that current assets have to always satisfy current liabilities. Well, it depends on how we acquire current assets. We may acquire them through borrowing or other kind of means. And so the types we're talking about, accounts payable, these are trade payables where we're buying things from suppliers on account, which is, payment terms, whatever it is, 30 days, whatever the case might be. Notes payable, again, tend to be more written, more formal. And in this case, we're talking about current liability, so it's a short-term note, and usually requires some sort of interest. And we say explicit means it's actually spelled out in the agreement itself. There's something written. It may involve lawyers, it may not, but it's something that really is breaking out what the terms of that particular obligation are. They tend to be large dollar figures, certainly larger than payables, and they usually are as I mentioned with notes receivable. They tend to be revolving around a certain transaction, a certain particular purpose. And then we have deferred revenues, and so we're almost out of time here. But deferred revenues, again, where the company's been paid ahead of time, and we're going to carry that thing over to a future accounting period for whatever reason, but we still have to deliver it. And one thing I think is interesting is this idea of gift cards, and we don't think of gift cards as being a big deal. By the way, there was an interesting story that came out about TGI Fridays, company that's in bankruptcy, the restaurant chain, and they've got all these gift cards that are out there. And franchise owners who are independent of the company, they're just people who own these restaurants, they were really kind of worried about, do they have to redeem these gift cards? They were kind of worried that people were going to dig out these gift cards from the drug drawers or whatever and start hitting the restaurant before the company went out of business. And that was a real issue. But gift cards are a liability. It's a deferred revenue. Somebody pays for something ahead of time. You have to deliver the good at some point. Indeterminate amount. Some of these gift cards have no expiration, whatever. And so as a result, that is definitely an example. And it's probably it's something I guess I've thought about before, because I can't tell you how many Starbucks gift cards I've got floating around my house that people have given me over the years. And Applebee's, I just never have redeemed. And I just hope and pray that the company's going to be there when I try to redeem them. But those would be an example of a deferred revenue. A prepaid item, the product or good has not been delivered yet. And then finally, the last piece, we're almost out of time, is accrued liabilities. These are things like accrued expenses, things like salaries. Salaries and wages are a big one. Also accrued interest payable. If we're doing adjusting entries at the end of an accounting period, we're going to pull these forward and say these are going to be liabilities, credit balance, and we're also going to recognize expense to match those up. Ultimately, those are going to be paid off, and they're going to be paid off in a current manner, but just not right at this particular point. Okay. All right. So, any questions? We're almost I think we're pretty much out of time today. So we'll pick this up from here on Tuesday. And again, we got plenty of time because week 3's activities, which we're into here, are not due until next weekend. So we've got some time. In the meantime, if you have questions about the activities for chapter 2, let me know. Get with me. Send emails the best. And I'm trying to get back with you as best I can. Sometimes I'll ask for a screenshot because I can't always tell what's going on without seeing the numbers. Those change. They're randomized in the Connect system. So kind of bear with me on that. But nonetheless, I'll get back to you as soon as I can. So anyway, good luck with what you're doing in chapter 2. I will present the rest of the chapter 2 video here, hopefully later today, assuming I can get access to this room, which is rather busy. And if I don't see you individually or talk to you individually, have a great weekend. See you next time.